Good evening, friends. Welcome to the call at the end of our first quarter earnings. I will start with focus on three key areas. One is fixed income, second is the loan market, and the third is the current investment strategy in some of our business segments as the three key areas, and then a little bit of overview about what's happening. So first on fixed income, we have seen the government securities yields move from 31st March levels of 7.4% to 30th June levels of 7.9%. Therefore, our results are on the basis of the fixed income yields as of 30th June. Now, there are three factors, as you are aware. We have taken a total delta MTM fixed income provisioning compared to last June of about 200 crores. Last June, the provision was about 11 crores, and this year, the total provision on fixed income mark-to-market is about 210 crores. As you are aware, three key factors which affect fixed income MTMs from an accounting point of view are, amongst others, but the three key ones are duration, number two, credit spread, and number three, accounting treatment on portfolio between what is HTM, that is hold to maturity, and what is not. So on the first one, on the duration, the bank runs a overall fixed income duration book as of 30th of June of modified duration of around 2 years. Second, there is no major impact on account of any significant deterioration in any credit in the fixed income portfolio. The third one is the treatment between HTM and non-HTM book. As of 30th of June, out of the total fixed income book, the book which is in HTM category of our bank is 46%, and the book which is not in the HTM category is 54%. Therefore, this MTM provisioning is arising primarily on account of the book which is not in the HTM category. And on the duration side, as you know, there is a sharp gap between a 1-year duration and a 2-year duration paper, which from the point of view of banking book at a repo rate of 6.25 gives a significant positive carry. Therefore, 1-year treasury as of end of June was somewhere around 7.10 to 7.15, and a 2-year GSEC paper was at around 7.65 with a repo rate being at 6.25. Therefore, the bank's strategy was to focus on this carry, which is significant from a 6.25 repo rate and also the gap between 1 and 2 years has been pretty attractive. So the bank has taken an average duration of modified duration of around 2 years because we see at this point reasonably positive carry, though a potential mark-to-market pain. And as you are aware, whether it's in the past or whether now, the bank likes to take the pain through the P&L and not doing any amortization of the mark-to-market book. So this is on the fixed income side. As you are aware, the yields are today lower than what they were end of June, but these are volatile markets. There's a monetary policy coming in, but fortunately for us, our book on fixed income is now mark-to-market very significantly on the 30th June levels. So that is first on the fixed income side. Second is on loan growth, as also credit and what are we seeing in the environment on credit. So on loan growth at the bank standalone, I'm happy to report a 24% loan growth at the bank level and consolidated 22%. If you may recollect, in the March earnings call, I had given an indication of loan growth in the 20s, and we are continuing to be in line with that as our core loan growth. However, there are segments and pockets within the overall lending businesses which we have continued to see some challenges. And the biggest out of that is the SME segment, or what we call as the business banking segment. This segment continues to have reasonable stress, and if you look at our GNPA and net NPA ratios, our overall GNPA, both in absolute numbers, has only marginally moved up, but compared to the last quarter. But our GNPA ratio is now lower than what it was in the March quarter. So we are now at a GNPA ratio of 2.17%. But we have significantly increased coverage, particularly in the SME book. And our net NPA, therefore, is now down to at 86 basis points, therefore well below 1%. So this is consistent with our view that balance sheet is a crucial part of banking and finance, and we believed it was appropriate to increase coverage, particularly in the SME sector, where we are finding some, and we believe this is a broader industry challenge, we are finding some behavior which is something which has to be watched out for. Whenever we are finding SMEs getting into any stress, in many situations, the first thing we find is so-called current assets against which may be charged to banks or lenders suddenly evaporate. And when we go out to find the details of those assets, either they don't exist or they have moved out of the books of the company. The second and even more disturbing fact, and something which we have taken significant internal steps, and I think it's a challenge back to the whole area of third-party fiduciary responsibility, is the role of valuers of collaterals. I believe there is reasonable reason to believe a significant overvaluation of collaterals across banking and finance industry, and this applies not only to banks, but probably also to the NBFC sector. And a time has come for us to really wake up in this mid-market and SME sector, including on property loans and everything else, where valuation of underlying assets is more appropriately done rather than having values which are not realizable in real life. So we have taken a more conservative approach and increased our coverage, though our overall stress levels are still well within control, just as a matter of conservative and prudent policy. And we, at the same time, we do believe that on the micro side, the loan growth opportunity for appropriate underwriting is attractive. Therefore, we are continuing with a loan growth in the 20s, as has been demonstrated by the first quarter loan growth of 24%. And that brings me to the third point, which is our continuing commitment of investment in the consumer segment. In March 2017, we had gone out with a estimate of doubling our customer base from 8 million to 16 million by September 2018. I'm happy to report back that as of June, our customer base has moved from 8 million end of March 2017 to 14.5 million as of June 2018. And we believe we are well on our way to achieving the 16 million number as of September 18, which would have doubled our customer base. We are currently adding between 811 regular account opening and also on the asset side a total number of new customers every 1 month, which is about 5 lakh customers per month, is broadly the indicative range at which we are continuing our customer acquisition. As you are aware, this is a continuing front-end acquisition cost, which we are taking through our P&L and propose to continue doing that. Therefore, as between the higher interest rate which we are paying on savings, plus this continuing speed of acquisition, we are on an annualized basis, if I take a number, between higher savings plus customer acquisition, we are taking about close to 1,600 crores of P&L pain through the bank's P&L on a full year basis annualized, and obviously proportionate for the first quarter. And that broadly is the breakup of 1,600 crores would be 1,200 to 1,250 crores on higher rates on SA, while our overall average SA cost is around 5.6%. It's still about 200 basis points higher than what most of the larger banks are paying, which is a cost of around 3.6. And of course, another 300 to 400 crores on the acquisition strategy, which we have implemented. Therefore, as between fixed income, where we have taken a delta provisioning on our non-HTM book, which is a higher percentage of the marketplace, though our duration is well controlled at around 2 years. Our continuing focus on loan growth, but increasing coverage in segments which we think are problematic, including SME, and a serious review on the overall collateral situation, and the continuing investment in consumer is the core of our overall theme and focus as we go into 2018-19 for the rest of the year. Our micro view continues to be positive with appropriate risk management and checks and balances, and we do see this year, as we proceed through the year, a continuing growth opportunity, both in terms of market positioning as also returns. On the returns and the NIM side, we have seen some pressure come out of the historical book, but my personal view is that we are close to a bottoming out of the NIM cycle as well, and we are seeing early signs of having some ability to price better than what we had over the last 9 to 12 months. So this is a broad picture, and with that I'll hand it over to Jamie.
Thanks for that. I'll quickly take you through the earnings update which was circulated earlier today. At the consolidated level, we end the quarter with a post-tax profit of 1,574 crores, 17% higher than last year. Tier 1 at the consolidated level at 18%. Total assets at the consolidated level of 3,45,000 crores, and with this we end up with a book value of 273 rupees per share. Other than the bank at 1,025 crores, the contributors to the quarter profits were Kotak Prime at 139 crores, the securities company with 130 crores, Kotak Life Insurance at 117, the mutual fund at 51 crores, and Kotak Investments at 48 crores. The net worth at the overall group level now at 52,000 crores. Advances book at the group level at 2,13,000 crores, and as Uday mentioned, 22% growth YOY. The net NPA at the group level at 0.77%. For the bank standalone, post-tax profit for the quarter at 1,025 crores, with CASA now standing at 50.3%. We've seen good growth in both the average numbers for current and savings account. The current account, if I look at average for this quarter versus the average for the same period last year, has grown by 24%, whereas the savings accounts have grown average 59%. CASAs plus the term deposits below 5 crores have also shown now constitute 79% of the total deposit base. As regards the P&L, the net interest income for the quarter at 2,583 crores. Fees and services constitute 989 crores out of the total other income of 1,165 crores. At operating profit level, we see a total operating profit of 2,033 crores, about a 27% rise on a YOY basis. And Uday did lay out the reasons for the provisioning increase both on the investment side and the advances and receivables. As a result, we end up with a provisioning of 470 crores this quarter, which is against 204 crores for the same period last year, which results in a pre-tax profit of 1,563 and post-tax 1,025. Our wealth management relationship value is now at 2,54,000 crores. The advances at the bank have grown to 1,76,000 crores with a growth of 25% on a YOY basis. We've seen growth across the board. The corporate book has grown by about 25%, commercial vehicle construction equipment by about 40%, small business personal loans by another 41%, the agri businesses at about 16%. Our SMA2 outstanding still at 0.11% of the advances at 189 crores, and GNP at 2.17 and net at 0.86%. Our overall balance sheet size at the bank level now at 2,71,000 crores. Before I come to the subsidiaries, I request Shanti to take the digital ones.
So on the digital side, the enablers first. Our app continues to be rated amongst the highest at about 4.7 in the Apple and 4.5 in the Google Store. We've launched a new payment section for our customers, which makes it extremely convenient to serve all their payment needs at one stop. And our mobile banking volume for the month of June crossed 1 crore transactions and 10,000 crores in value. We continue to enrich KR, our chatbot at our customer contact center, with new learnings towards servicing our customers. And in this quarter, we introduced WhatsApp banking, a new channel for servicing customers for certain types of services. 89% of our recurring deposit in terms of numbers, 67% of our fixed deposits continues to come through the digital channels, and mobile continues to be a preferred mode for many of our customers, and we've seen a significant increase in that aspect. 811, as Uday had mentioned, we continue with our thrust on 811, and if you look at some of the key metrics, 44% comprises salaried, 60% of our top customers are from the top 20 cities, 91% of the customers, in fact that percentage has increased, are between 18 and 40 years, and we service customers across 6,700 PIN codes. We've introduced many elements in our 811, and we will continue to do that with the focus on service as well as cross-sell. On the payment and the lending side, our payments gateway transactions in terms of volume grew 70%. Again, UPI saw 42x growth in transaction value over the one-year period, and including our mobile store. 30% of our incremental PL business comes through digital channels. We introduced a super fast home loan for salary segment in under 4 hours. That is showing very good traction. In terms of we continue to enrich our branches with digital elements and introduce digital lobbies to be able to service and help our customers service themselves. And in terms of our subsidiaries, Kotak Securities continues to focus on the digital side. In terms of the average daily volumes, 78% growth in the cash segment on a YOY basis and 99% on a total basis on average daily volume has come through the mobile channel. Both in life and general, new acquisition continues to be focused through the digital channel. Jemmy, back to you.
Sure. Taking the subsidiaries, the life insurance entity ended this quarter with a total premium of 1,200 crores, which is about 23% higher than last year. New business premium was 659 crores for this quarter. Ended with a profit for this quarter at 117 crores. The securities company ended with an average daily volume of 14,000 crores per day, with a market share of 8.3% in the cash market, ended with a post-tax profit of 130 crores for this quarter. The investment bank has been involved in several issuances, block deals, as well as on the advisory side, and clocked a 25 crore post-tax profit for the quarter. The assets under management at the group level now just below 2 lakh crores, which is about 31% higher than what we had 1 year ago. The domestic mutual fund has seen assets under management grow significantly. We are at now 1,28,000 crores as average assets under management for the period. Market shares have grown both on the average as well as on the equity side. The PMS, which is under the mutual fund, has grown 70% on a year-on-year basis. Kotak Prime clocks a profit of 139 crores for the quarter. The overall advances booked there at about 28,000 crores, of which 20,000 odd crores is passenger car financing, with the non-car book actually slowing down over the last year. The book being pretty clean with 0.39% as net NPA and CAPAD at 17.7% there. The investment company with, again, a net NPA of nil, 7,700 crore advances booked, and with a healthy CAPAD of 19.3%, clocked a 48 crore profit for the quarter. So that's probably been the highlights. Would be open to taking questions.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touch-tone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to limit their questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up. The first question is from the line of Mahrukh Adjania from IDFC Securities. Please go ahead.
Yeah, hello. My first question was on corporate credit growth. Is that driven by NCLT or the general growth that you see? And amidst the PCA noise, is it now fair to assume that 20-25% is the sustainable run rate of corporate credit, despite all the noise on PCA banks and also opportunities in NCLT? That's my first question. My second is your reading of the CV cycle, because there are many views on fuel hikes and other issues.
Yeah. I think first question will be answered by Manian and on the corporate side, and thereafter Kannan on the commercial vehicle side.
So, so on the corporate side, it's not only driven by NCLT. I think it's a reasonably secular market share gain. And yes, of course, as you said, PCA is helping us gain market share here. So it's not only driven by NCLT. One. Second, we do think anywhere between 20 to 25% kind of growth is sustainable here.
On the CV cycle, on the CV cycle, the growth during the last 12 months has been reasonably good. There is some confusion because of this recent notification on overloading, but still not clear. We expect the market to grow by about 10 to 15% still. But if the old vehicles are also allowed to be overloaded, then we might not see too much of growth on the M&HCV segment.
Okay, just a follow-up question on this NCLT thing. So how many cases would you have funded? Any such?
As of now, we have funded one case.
Oh, okay. And are there many in the pipeline?
Yeah, there are a few in the pipeline.
Okay, thank you.
Thank you. The next question is from the line of Rahul Jain from Goldman Sachs. Please go ahead.
Yeah, hi. Good evening, everyone. A couple of questions. First one is, what has happened to the yield on investments during this quarter? Can you just share some color on that? Did they go up or down?
I didn't get a question, Rahul.
So what happened to the yield on investments? Yields on investments.
Yields on investments?
Yeah.
Yeah. I think this is one of the reasons why you're seeing some moderation in the yields is as we have moved towards lower duration.
Okay, and given that,
Sometime in the second half of last year, we began to reduce our duration. Therefore, as of end June, we have brought down our overall duration down to 2 years. And you know that as you go towards the shorter end, including on T-bills, your yields get lower. So this is a trade-off between price risk on duration versus current yields.
Okay, and how do you see that kind of shaping up, say, in the next few quarters?
I think broadly on the investment side, our view is modestly cautious. We don't I mean, at this stage, of course, depending on a lot of factors, including politics, fiscal, impact of price increase, MSP increases, as also the state deficit. But our view is reasonably cautious on bond yields. And we can debate whether the range is 760 to 820, but that's broadly the range in which we would like to believe the 10-year bond in India should behave on the 10-year side. And as you know, T-bills are now at 720. So the carry between 1 year and 10 years, similar to what you have seen, Rahul, happen in the U.S., you're seeing the yield curve between 1 and 10 years getting significantly flatter. And interestingly, 2 years is giving you 765, 10 years today at 775 or 772, whatever, 777 today. So particularly where you're holding the book, a very significant part of your book is not for trading but for holding as a banking book. The carry joy on yields for longer tenor risk has moderated.
And can I just ask one more question on this particular topic? What would be our average yield on the AFS portfolio?
On the?
AFS portfolio.
Yeah, we run the book much more as one single book. And on HTM, if it is above a certain tenor, only then we put in HTM. Therefore, we don't put a 1 or 2 year paper into HTM. Okay.
Got it. The second question is on your view on the lending spreads. So for the last couple of quarters, we've seen these spreads have been kind of trending a little bit southwards. I understand, you guys are financing in AAA market, AA market, but typically, how would you guide us, for the following quarters in terms of lending spreads? Do we see those further go down or will remain flattish? How do you see those play out?
The answer is we think we have bottomed out. The speed of the increase is, from our point of view, we believe that we are going gangbusters on increasing our CASA. Okay? So now 50% of our deposit base is CASA, and that is not a ceiling. We would love to see it keep on going up. And as you know, CASA is a fixed rate book. And if interest rates in the economy go up, we obviously would like to get benefits out of that over time, particularly since we are growing our SAP and CA books at a reasonably quick trot. Therefore, if that fixed rate book of ours keeps on going up faster than the rest of our deposit base, and obviously if we can grow it faster than the loan side, then obviously the juice is there. And we do believe interest rates on the lending side will go up. However, in the short run, one of the things which I think we have to keep in mind is there's a fundamental difference between the base rate regime of interest rate increases versus the MCLR regime. What do I mean by that? Bulk of our floating rate book is priced off our 6-month MCLR. Okay. Say, for example, if we have given a loan in month of June and we increased base rate on July 1, then in the base rate regime, the transmission of the higher rate would have been passed on to the customer effective July 1. In the MCLR regime, the increase for a June loan will be transmitted to the customer only in December. So there is a time lag for transmission in the MCLR regime depending on whether your customer floating rate is linked to 3 months, 6 months or 1 year. And that transmission time is something which is it is like work in progress. And a very significant part of our book is 6-month MCLR. Therefore, you've seen the beginning of interest rate increases in our MCLR start around March. So as we go forward, we see this beginning to transmit itself into the floating rate on the asset side.
Okay. Because the other part was actually a little bit more philosophical, because traditionally we've kind of stuck to kind of maintaining, risk-adjusted margins of, 380 to 400 basis points. But for the first time we've gone below that, or maybe second time we've gone below that threshold.
The margins are still, NIMs are what? 4.3%.
No, I meant risk-adjusted NIMs, which is excluding the credit cost out of it. So I was just kind of interested in understanding, are you comfortable with with these kind of pricing, or would you kind of...
I think the fundamental reason why you're seeing this the time lag gap is coming out of the MCLR regime versus the base rate regime.
Okay, got it. The last question is on the business banking portfolio and the NPL concern that you sounded out. So the slippages seems to be kind of, broadly or maybe lower than some of the previous quarters. And the book in business banking actually has kind of remained broadly, in the single-digit growth. Yeah. So for how long do we kind of, watch this portfolio? When do you see that portfolio start to grow again? Any color on that?
See, Rahul, what has happened is the segment which has got most hurt, whether it is demonetization or GST, it is the business banking segment. And as you know, essentially a lot of the SMEs in India have traditionally been financed by the public sector banking system. A lot of these SMEs have been significantly undercapitalized on the equity side. Therefore, a combination of external changes with thinner equity and challenges to some of the challenges in the banking system have all converged to put pressure on this segment. As a result of which, the ability to absorb shock by this segment is limited. Combined with this, and the more important point, and it's not only in the SME segment, it could be in some other segments also, is we have seen challenges which, in recent times, which you got for third-party fiduciaries, including, say, auditors. But one other big weak spot in Indian finance is the role of valuers of collaterals. And this is a history over a long period of time where I'm not giving you some big secret. The history for a long period of time, whether it's the borrower or a friendly, flexible banking officer in many places, the easiest way to give more money to some of these guys has been increase collateral value, valuer giving a significantly higher value to a collateral, whether it's a factory or land or plant and machinery, call it what you want. And this was this was one of the best public secrets of Indian finance. And we are beginning to see that in some of these cases, when you're going out to actually realize value on these collaterals, the collateral realization is a fraction of what these valuers have given. Yeah. And this is something which, like if you and I spoke in 2011-12 about project finance and large corporate loans, I was the one who raised concern on for fundamental creditworthiness of some of these large project finance loans. I am today raising similar concerns on fundamental role of collateral valuers and the real truth of those valuations.
Okay.
And that is something we have recognized it. We have started taking the corrective measure. We think this is something which is a system undergoing a fundamental correction, and there is no real authority or body which is regulating these valuers. Anybody in India can become a valuer.
Okay, yeah. So, for how long do we see this transition or the sort of adjustment phase to kind of last? Do you see this year?
I think having said that, Rahul, we are not shy of loan growth. But our fundamental belief is, if we are giving money, we must first have a reasonable comfort we are going to get it back. And the so-called security which we are supposed to have is really the security we have. And therefore, we continue to guide on the 20s loan growth overall. But we'll certainly not want to give money on some bogus collateral.
Got it. Thank you so much, Uday. That was really helpful. Good luck for the future quarters. Thank you.
Thank you. The next question is from the line of Nilanjan Karfa from Jefferies. Please go ahead.
Hi, thanks. Thanks for the opportunity. Just going back to the previous question and your commentary, Uday. if we look at any loan book, right, whether it is Kotak Mahindra Bank or any other bank, I mean, there's a huge amount of secured loans, right?
Yes.
Practically, if you just exclude the, pure personal loans and credit cards, practically everything is secured. How do we value then? I mean, if you are raising a question on valuers, do we have so many number of internal valuers that, you are still comfortable growing 20%?
One of the things we are doing is investing in getting stronger and stronger technical valuers inside the bank, okay? Therefore, for regulatory reasons, we may need an outside valuer, but we are dramatically strengthening our internal technical valuation capabilities.
If you could, give an example, that will be useful.
So we have seen in some of the so-called real estate valuations or factory valuations and others, the realizable value versus what is the valuation which and some of it came to us from the acquisition of ING as well. The valuation, as per RBI, valuations are valid for 3 years.
Okay.
Fixed asset valuations are valid for 3 years.
Okay.
When and in some of those accounts, when they went into stress, between what was the valuation report on paper we had versus what we are able to sell, the number is not 20-30% lower. It is 50, 60, 70% lower. And that's when about a few months ago, we started looking at this closely, and I'm really focused on getting the fundamental valuation of so-called secured assets. Because, the trouble is, on the one hand, you price secured assets loans at a more attractive rate. And then if it is effectively unsecured, and a lot of your core lending and comfort comes out of security, we are burning our boats on both ends. Neither are we getting the spread of an unsecured loan, nor are we getting the real value of the security we are supposed to have.
Okay. Let me ask it in a different way. Let's say last year, maybe we knew about these issues, but let's say our last year credit cost was, let's say 700 crores roughly, right? If you average it on a quarter, maybe we should have done 150, 160. I'm assuming, therefore, that additional 75, 80 crores that we have taken, do you think that adequately values our collateral? Or do you think we need to go up very, very significantly?
The good news, there are 2 points which when you look at our numbers, look at it. Number one, our absolute level of net NPL is now down to 0.86. Number 2, in terms of flow, look at our SMA2. Our absolute number on SMA2 is about 180 crores. So these are the 2 important numbers you got to keep in mind and take a view about what we will be needing to do. Obviously, we don't believe the value of a stress loan is 0, but even if you took the value of a stress loan at, say, 30 or 35%, we have probably post this provisioning already at 60% provisioning. Therefore, we are holding the entire NPL book of ours already at 40%.
Sure. Okay.
On 2.17 GNPA and a net NPA of 0.86, it means we have provided 60%.
Right.
On the entire book. And we don't think the value is 0, but the value is lower than what we would have thought 6 months ago.
Right. Okay, great. And on the SME pain that you highlight, I mean, you have been doing it for a while, but looks like you are getting a little more, cautious about that. Which specific segment do you see? I mean,
cautious about fresh lending, but we will do better underwriting. That is what we are moving towards. And we'll be more real in what we think if it is secured, what its true collateral value is, rather than being taken in for a ride on bogus valuations.
Right. I mean,
and the good news is that thanks to some capacity tightening, our ability to push what is right is better today than ever before.
Okay. See, there was this assumption, right, with GST, for example, while there will be a transitory pain, maybe that continues, but you will have better tax information available, as banks, you get, larger data to underwrite. Is that not happening?
Not fast enough yet. But having said that, I think it's a very important point. We do see the value of cash flows in our views. And therefore, cash flow is a very important aspect about how we will look at lending in addition to collateral. But we won't fool ourselves with artificial collateral numbers.
Sure. Okay. And just a data keeping question. Could we have the, risk-weight asset at both bank level, the consolidated level, and the third is the credit substitute on the bank?
Jamie?
Just have it right away. Just give a minute. About 2 lakh cost crores at the bank level.
Okay.
And at the group level, about 2.7.
Okay. And the credit substitute, please?
Just 1 minute. Yes, I'll give that to you.
Sure. Or I can take it offline. Thank you so much.
Thank you. Participants are requested to limit their questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up. The next question is from the line of Amit Premchandani from UTI Mutual Fund. Please go ahead.
Good evening, sir. Thanks for the opportunity. You spoke about the SME loan part. Can you quantify the total amount of SME loan in the Kotak book?
See, there are, if you look at our loans, I think that there's in one of our earnings update slides we have given, essentially when we are talking about SME, we are talking about business banking. And that number in our is about 18,000 odd crores, which we have 18,000 crores, and on a year-on-year basis, we have grown that at only 5%.
So it's only
3.5%.
nothing else.
And by choice, okay?
And it's only business banking, nothing else in the...
Primarily business banking, but the issue about collateral and fair valuation, we think permeates much deeper across banking and finance on many categories of secured loans. Sure. And this is a banking and financial sector issue, not necessarily a Kotak issue.
Sure, sir. And sir, your staff cost in the bank is now at a 4-quarter low. Are we reducing employees in the bank over the last, say, 3-4 quarters? Or are we seeing the impact of digital-led initiatives that you have taken?
No, I think we need to recognize, if you're looking at a quarter-on-quarter basis, previous quarter we had explained the fact that thanks to changes the payment and gratuity rules, we had taken a one-time hit in the previous quarter. So if you take that out, actually it's an increase on a quarter-on-quarter basis also.
Yeah, but even on a YOY basis, the growth is only 2%, and the balance sheet has grown almost 20%.
Some amount of benefit you get on account of the fact that you have retirement benefits, which are kind of discounted on the basis of interest rates. And to that extent, because interest rates have gone up, you would get some benefit there.
Okay. And so finally, on the consumer durable side, what is the book size as of now, and what are the strategy that you are kind of implementing on that?
Yeah, we just actually in the bank launched consumer durables. So it's, as you know, these are small ticket loans and reasonably short tenors of around 6 months. So the book is just building, so we'll have to wait a few quarters for us to really share.
Broadly, consumer bank loan growth has been in excess of 30%.
Yeah. But that's the consumer bank retail assets growth has been above 30%. You asked for durable specifically, that's just building out.
Okay. Thank you, sir. That's from my side.
Thank you. The next question is from the line of Vishal Goel from UBS Securities. Please go ahead.
Hi, sir. Thanks for the opportunity. So 2 questions. One, in the net interest income line, especially the income on other sources, so that line clearly has gone down. while there is no significant increase in the interest on investment also, like on a quarter-on-quarter basis. So if the carry trade were to work, I mean, I'm just trying to see whether it should have reflected somewhere, at least in the interest on investment line. But so what explains the decline, the significant decline in the other income from other sources?
Between Q4 and Q1, or are you looking YOY?
No, Q4, Q1. Yeah.
See, on Q4 on other income, normally you have a big push on life insurance. And Q1 is normally the lowest on third-party distribution.
No, sorry, sir. No, I'm talking about interest from other sources, like interest income from other sources, like which is RBI and balances with RBI and all that.
Yeah, but those are very small numbers anyways, Vishal. That's about 100 or not crores. And the balances, average balance we need to look at with those entities have also come down significantly. It's not that the rates have gone down.
You're talking about 92 crores versus 183 crores.
Yeah, basically, if you add that, correct.
It's not a big number, but I think there may be a good reason for that.
Yeah, the amount of balances which have been kept there also have been lower than an average.
Okay. And the other thing is on the Kotak Prime. So there, obviously, there is no hardly any growth, and I think there was a plan to do other than car business also there. So any thoughts on that?
Yeah, I think first on consumer durables, which earlier we were planning to start in Kotak Prime and we were ready with everything else. We have moved. It's now going to be done in the bank, and we are very focused on launching it as we talk. Or we have done the test market launch already, so we will see that happen in the bank. In Kotak Prime, we are in the process of getting into two-wheeler business. I'll ask my colleague Narayan to speak about when he is launching that.
Yeah.
It is two-wheeler financing business. So we think the time has come that in addition to four wheels, which is what KMP primarily does, time has come for two wheels as well.
As Uday said, we have done the homework, the board approval is in place, and we should be launching it anywhere next month for two-wheeler financing.
Next month,
that's right. We have done all the necessary build-up for it, the infrastructure, etc. So next quarter, or preferably end of March, you should see some good asset coming out of this business. Yeah.
Okay, and just one data keeping question. On the insurance business, was there any impact of, increased interest rates in terms of, like mark-to-market losses also?
See, there are two parts to insurance business, particularly if you're running a non-par business.
Yeah.
Yes, there is a mark-to-market impact which happens when rates go up, but also the flow of future premiums. Yeah. Reinvestment rate of those premiums, because your non-par is a fixed rate book on the liability side, your future premiums investment rate also goes up. So depending on whether your stock is larger or flow is larger, based on that is the net impact of interest rates on your overall insurance IEV. Having said that, we have taken a view in order to build the business steadily. We will be giving the insurance EVs once a year.
Okay. Thank you. All the best.
Thank you. The next question is from the line of Nitin Agarwal from Motilal Oswal Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. My first question is on the savings account. Now, if I see the SA accretion this quarter is one of the slowest in past many quarters. So are you seeing some movement from SA balances into other high return assets? And related to it, like if you can give some color on how the average SA balance has moved between 811 and the other regular SA accounts.
So, what was the first question? It wasn't clear.
Yeah, it wasn't clear.
So the first question is the SA accretion this quarter is like one of the slowest in past many quarters. So
I think compared with last year's March to June quarter.
And also, I think there are average numbers which are put out in the earnings subject also. If I look at the average numbers, this quarter is about 56,300 crores versus previous quarter of 52,000 crores, which is about 7.6% growth. And if you look at the previous...
7.6% flat growth.
For the, it's not annualized, so that's about a 31% growth for the on an annualized basis. And if you look at the year, it's significantly higher at 59%.
Okay, and how the average SAR balance has been there between 811 and the other regular SAR accounts?
At this stage, we will share with you at an appropriate time.
Okay. Okay, and not even like some directionally, how is it trending?
The 811 balances are building up quite well. We think it's still a lot of juice out there which we want to get, and we are seeing a clear, steady pickup, and we think it's something which we are very committed to, and we are quite happy with the progress.
And sir, our SAR strategy, like, will it remain the same to offer higher SAR rates? Because now we have
when your 1-year bank CD rate is 8%, what is the problem in getting average SAR at 5.6%?
Okay.
So we are not driven by what others do. We know we've got a huge positive carry. We are growing SAR steadily for many, many years at 40%, and industry which is growing at 10 to 15%. We think we have got a very good thing going. We have got a 2.5% spread versus 1-year CD. Why should we worry about what others are doing? And why should we worry about short-term this thing? We are adding, on our base, we are adding more than 50% new customers. And this is the time to go out there and in the marketplace and get customers, engage them, broad-base, and really get market share on customer accounts. So this is our time to really grow. Why bother about what happens to me in 1 quarter or 2 quarters? I mean, we can talk about this game over the next 2 years.
Yeah, sure. And so lastly, like, what is the plan on reducing the promoter ownership? Are we requesting for any...
We are evaluating all options.
Okay, so the December timeline still remains the same, so there is no...
Yeah, I mean, we have disclosed to the market whatever is the RBI requirement, and in that context, we are evaluating all options.
Okay, thanks so much, sir.
Thank you. The next question is from the line of Kunal Shah from Edelweiss Securities. Please go ahead.
Congratulations. Firstly, in terms of the overall advances, so given what is happening on the commercial vehicle side, plus what you highlighted on the business banking, and we very much getting into the election year as well. So how are we overall positioning in terms of the mix in the near term over next 1.5 odd years, and also in terms of the overall quantum of growth, what we should be comfortable with?
We continue with our guidance, which we did at the end of March quarter, which is growth in the 20s. We continue with that guidance.
Okay. And in terms of mix, should we see that given the opportunity which is there on the corporate banking side, and maybe what are the challenges, be it on the commercial vehicle or business banking and the other secured segment, do we see that proportion inching up further?
Kunal, on this one, it's a very fast-changing environment. 1 week ago, the view on CVs would be very different from what it is today. So as they say, 1 week is a long time in politics. The same principle applies to any risk business. And we will keep flexibility, keep the philosophy of going out there and giving money where we think we can get it back with reasonable returns.
Okay. And on the unsecured side, so would that focus would still be continue in terms of the unsecured play?
Yeah, I think at this stage, we think things are okay. I think my personal view on unsecured, the challenges are 2020.
Okay.
Until then, the market should be happy as banks and NBFCs keep on compounding and unsecured keep on booking profits, when really in unsecured, the profits are only in the last few quarters of the loan.
Okay. So, but overall, maybe in terms of penetrating into our existing customer base, is that largely done, or maybe we see...
we are adding 500,000 customers a month.
Okay.
Shanti, you want to say something?
No, I think if you look at unsecured business and credit cards, today, in fact, 90% of all our incremental sourcing comes from our existing customers. So also increasing based on personal loans and home loans. So I think our focus, as Uday said, we are adding customers quite substantially, and on the retail side, on the unsecured side, we are going deep into our customers.
So where's the question of reaching all our customers? Yeah, if we add 60 lakh new customers a year.
Yeah. On the overall basis.
Yeah, and our view is that we may get a customer on the liability side, but we will certainly try and leverage that customer across our product range.
Okay. And lastly, in terms of the savings deposit, so given that now we are almost like say 50% CASA, and even on a per branch basis, when we look at it, we are like much ahead of the peers. So would we say maybe in terms of at least the benefit which was to flow through from maybe the ING Vyasa customers and deposit customers, we have largely got that benefit, and now the pace should slow down from here on?
See, Kunal, I'll have Shanti answer that, but let me tell you our ING Vaishya customer base, and actually I've got a new colleague of mine who I want him to answer on this call is Virat. Our ING Vaishya integration took longer, and therefore we started doing synergies a little later, but I think there is still more juice. But Virat, you want to answer that?
Yeah, you see, in terms of the customers, they are getting used to the products that we are offering. Earlier in the ING version, they didn't have. So those customers who were relatively maintaining lower balances, they have started getting in. And more importantly, we have not got a network where we can go and capture the customers. 811, of course, is adding value to it because in and around those branches, we can go and acquire new customers. So the CASA growth rates, now I think we are more or less at par with what we used to get before the merger.
Before the merger. Okay, but in terms of the industry, we would still be better than them.
See, Kunal, we have to do our work. That's our job, yeah.
Okay.
Why drive our line based on what others' line may or may not be?
Yeah, because in terms of per branch ratios, when you look at the productivity for Kotak, it has improved very significantly over the last 2 years. So, firstly, congratulations for that. But maybe where do we finally settle? Okay, so are we largely done with it, or we still?
You know, 50% is half of 100.
Yeah. Okay. Okay, great. Yeah. Okay, all the best for the future quarters. Thank you.
Thank you. The next question is from the line of Krishnan ASV from SBI Cap Securities. Please go ahead.
Hi. Thanks for taking my question. This is just pertaining to your commentary about, overvaluation in the business banking segment, and that may actually permeate other business segments as well. Given this risk is not something, as you rightly said, this is a well-known secret, a public secret. Obviously it was always, understood that Kotak would be far more conservative in their own internal valuation. Why necessarily benchmark yourself just to what the external valuers are telling you? I just wanted to understand, could it be a trade-off between when you start looking for high growth, this is a necessary evil that you need to now live with?
No, my point is, first of all, it's always, let me say one thing. Project finance and large corporate loan issues came into being in 2007-8. And they are playing out over 10 years. So when all these major issues come out, it takes a long time for it to play out. We believe valuers is a thing which is just now beginning to flow out. So we've seen issues around auditors. I think valuers are an issue which is nobody has really questioned what is the basis of these valuations. So yes, and keep in mind we got a fair amount of business banking book out of the merger. And we are now very clear. We are strengthening our technical valuation, and if the true value of the security is less, we are still open to looking at those accounts, provided we can justify on strong cash flows independent of the security. But if your decision is based on a security and less on the cash flows, then we are doing a wrong underwriting. We are not scared about lower value of security if we can lend based on the cash flows of the company. But to not look at cash flows as closely, but to look at security value as the basis of lending and then getting surprises on that which are disproportionate is the issue which I think will be an issue in the financial sector over the next few years.
Right. So you're raising this red flag, I understand, Uday, but all I'm trying to highlight is the fact that this is not a new risk. I mean, this has been broadly known that you tend to inflate your working capital, your receivables, your inventories. I mean, that's the way the MSMEs have been functioning for a fairly long period of time.
Correct.
I'm sure your bank has generally been at the most conservative end in terms of.
I think there are some external environment changes. You have had a demonetization.
What happens really is these are okay and acceptable under normal growth times. But when stress levels start increasing, NPLs start increasing, and you get on to resolution and recovery, that is when some of these really get heightened. And I think we are seeing some of that play out there.
And what is also happening in the SME segment, that should a loan get into stress, so one is a collateral. Secondly, you're supposed to have current assets, but you'll find it difficult to find out where the promoter is or the current assets. And then, and then you're seeing an empty factory or empty some place, and then you try and say, okay, this collateral was valued at 20 crores, and you go and try and sell it, it's single digit.
Right. I mean, my only point to that is that, if you are flagging this off as a red flag, I'm assuming Kotak Mahindra Bank is probably in the top decile in terms of your ability to underwrite and highlight these risks. I'm just wondering what this means for the rest of the system. That's the only thing that I'm trying to. That's the only thing I'm trying to.
I think that's a good question. It's a system level issue. As far as we are concerned, we are at net NP of 0.86 on a GNP of 2.17, which is a 60% provision, and we have increased the provisioning in the April to June quarter clearly by design, because we believe balance sheet is far more important than anything else in banking and finance.
Fair enough, I'm done. Thank you.
Thank you. The next question is from the line of Ashish Sharma from Enam Asset Management. Please go ahead.
Yeah, hi. Thanks for the opportunity, sir. So just two questions first on the strategy side. One is on your rationale for doing the consumer finance business in a bank now instead of earlier when we had mentioned that we would want to do it through Kotak Prime. What's the rationale on that? Second would be, are we also exploring whether we can do even the microfinance business, because we had done a very small acquisition in BSS Microfinance, but does now, given that we have seen some successful companies who have demonstrated that this business, MFI business, under a banking architecture is profitable. And just lastly on general insurance, it's a work in progress, but given the secular opportunity in general insurance business, are we looking at any inorganic opportunities in that space? That would be my question, sir. Thank you.
Okay, three questions in one. Answer to the first one on the consumer finance business. The reason why we have decided to do it in the bank is because we think technology can be managed better in the bank, and we have a much better process and speedier process thanks to our experience on 811 in terms of KYC and ability to grow that book better. So we've done a pretty detailed analysis on that and then taken a call that we will do it out of the bank. Second, on microfinance, our experience on the BSS microfinance is good. We have, the reason why we feel comfortable about it is because we have a quality team, not very large, manageable, and we believe that it has been a very good acquisition for us as long as we think it is managed well and not sort of let go out of control in terms of relative size. But keep in mind, BSS Microfinance now is acting as a BC to the bank.
Sure.
And third is on general insurance. Yeah, we think general insurance business is good. We are always looking for opportunity, and in the meantime, we are continuing to grow it organically, and we will report back progress on either, if there is, or both.
Perfect. That will be all. Thank you, and all the best for the next quarter, sir.
Thank you. The next question is from the line of Roshan Chutki from ICICI Prudential Asset Management. Please go ahead.
Yeah, thanks for the opportunity, sir. In your assessment, what is the two-wheeler finance penetration like based on your surveys that you have done?
Sorry, two-wheeler finance penetration. What? Two-wheeler. Two-wheeler, what is the penetration going to be?
Finance penetration, what does it look like for the two-wheeler segment?
Finance penetration is very high. We think it is about more than 80%.
More than 80%. Okay. And how many 811 customers do you have now?
We have, as I mentioned, we have a total of 14.5 million customers, and we are seeing a faster growth both in 811 and regular customers. Both are growing at a pretty good clip.
Sure. Thank you so much. That is all from my side.
Thank you. The next question is from the line of Gurpreet Arora from Quest Investments. Please go ahead.
Yeah, hi. Good evening. Thank you for the opportunity. Two quick questions.
Be a bit louder, please.
Yeah, can you hear me now? Yeah. The CD ratio, the credit deposit ratio for us has been inching pretty high for last 2.5 years. So is there any internal benchmark we are working around as a sustainable or stable level? And a related question to that, is it fair to assume that had the CD ratio been slightly lower, we would have grown the advances at a slightly higher pace? That's one question. The second question is, what has been the conversion run rate of 811 customers into normal accounts, and what sort of cross-sell are we able to leverage on that? These two, please.
Okay, first on CD ratio, I think we've got to divide it into 2 or 3 parts. Our view is a good CD ratio would be in the early 80s, say 80 to 85%. Okay, in an environment where SLR is about 90% and CRR SLR at about 23%. What is happening is structurally we are moving our deposit base more retail. Therefore, our mix is changing much faster and we are beginning to reduce our dependence on wholesale. But the retail takes longer time to build up. So we are significantly increasing the focus on retail deposits, which is primarily deposits below 1 crore in addition to Ka and Sa. So the mix change is beginning to work in our favor. But while you're doing this transition, if the loan growth is at 24-25%, we need to make sure that we fund the balance sheet. The next important issue is that loan growth is coming to banks at a time when there are many banks who are continuing to take deposits but having no loans, including the PCA banks. So it's a very strange situation which you are going through. There are really 2 parts of banking. Both are getting deposits, but one part of banking is getting deposits but not adding loans. The other part of banking which is growing faster than the banking sector average. And at a time where the interest rates are moving up, also money going into liquid funds and competing instruments. So there is a chase for deposits by people who are growing faster loans.
Sure. So for us to achieve 80-85% CD ratio, you think 811 itself would suffice, or we need to do another round of branch expansions?
This year we propose to add about 100 branches in the current year.
Okay. And my second question regarding
these are not designated branches; they are real branches.
Understood. Sure. And my second question related to 811 conversion into normal accounts and the cross-sell opportunity there.
Yeah, let me say one thing. On 811, as we said, we will keep on sharing with you information at the right points of time. All that I can say, we are very happy with the progress.
Sure. That's it for me. Good luck for the future. Thank you.
Thank you. The next question is from the line of Prabal Gandhi from Nalanda Securities. Please go ahead.
Hello. Hi, sir. So first of all, as you mentioned that you are targeting loan growth of 20%.
Louder, please. We are targeting loan growth in the 20s.
Yeah, in the range of 20%.
20s. So anywhere between 20 and 29.
Okay, so can you mention the segments which are going to get you this loan growth?
Yeah, as we mentioned, there are segments which we are careful about at this stage, one of which is SME and business banking. Now we have to watch commercial vehicles, the impact of the new law. So that is something we need to watch. But segments which are doing extremely well are construction equipment, pockets of wholesale banking, tractors are beginning to do extremely well, consumer loans, our consumer lending division is growing at 30% plus. So these are the ones which are in good shape.
Okay. And sir, in terms of balance sheet, so in quarter one of FY19 this time, so total assets went up by 2%, whereas the deposits went down by 2% and my borrowings got increased by 33%. And that money which came from the borrowings, from the increment of cash and balances, as you mentioned earlier, went into investments. And my investments rose by 10%, whereas my advances only rose by 4%. Any particular reason why investments had such a rise given the yield situation that we are in?
Why is investment grown faster?
Yes.
Also now we are moving towards by December 100% LCR requirement.
Okay.
And some of the credit substitutes also may have been done.
Okay.
So investments include various substitutes, not just GSEC or SLR, LCR paper. So what you're seeing is a combined impact, not just a standalone SLR investment impact.
And also, with liquid surpluses, we may have put something in mutual funds end of the year, end of quarter, which we may not have put end of the year. Are you getting me?
Yeah, but sir,
for example, on the mutual funds, in liquid funds, our limit is, as per RBI, 10% of our net worth.
Okay.
And but therefore, at the end of June, we could put about 3,500 crores in mutual funds, liquid funds.
But sir, on the investment side...
And end of March, this number was 0. So the delta between March and June on mutual funds liquid is 3,500 crores.
Yeah. Okay, but sir, on the investment yield side, we are getting yield of around 7 to 7.25%. Wherein on the investment yield side, we have been getting an investment yield of 7.4%, and this time it went down to 6.7%, which you explained that because of the provisioning and everything. Whereas in the yield on advances, we are getting yield of around 9.5%. So why not put all that money into advances and get higher yields when the demand is already there?
Baba, there is also credit risk, no? And we have a liquidity requirement and an LCR requirement as per RBI. We have got to maintain LCR as 100%, and this is another issue. On the whole investment thing, even at 100% LCR, out of the 19.5% SLR, only 13 is considered as valid for LCR. Additional 6.5 SLR is not considered as valid for LCR. So technically in the world of 100% LCR, which we start from January, the SLR should be fully allowed to be fall SLR and should not have a 6.5% number.
Okay. Yes, sir, that's it from my side. Thank you so much.
Thank you. The next question is from the line of Dhaval Gara from Sundaram Mutual Fund. Please go ahead.
Yeah, thanks. Just one question. So we've seen very strong growth in the relationship value of wealth and priority segment. Just wanted to understand, the number of clients that we would be engaging in the segment, and also what would be the broad contribution to our total income or fee income from the segment.
Jaideep Ansraj, who heads that business.
The total number of clients in this would be approximately 35,000 families. That's what would be across the entire relationship value.
And its contribution to fees and services or the total income for the bank broadly?
Well, we don't disclose that separately, but it will form part of each of the sub-businesses. The SAR, the CA, the deposit, the distribution. Each of those will have components of that.
Sure. And just, sir, if you could broadly classify, what would be the full year FY18 or this quarter, what would be a broad fee income breakdown between corporate and retail?
Lot more in favor of retail. We don't have investment banking revenues which are dramatic in the bank.
Would you say 75-25?
Jaimin, you would have, what is the retail?
If I look at about 989 crores, at least about 600 crores would be coming from the consumer and commercial banks.
So about nearly two-thirds.
It doesn't include trade finance and whatnot, which again could have a component of commercial.
About 75%, give or take.
Sure, sir. Thanks.
Thank you. The next question is from the line of Pranav Tendulkar from Rare Enterprises. Please go ahead.
Hi, am I audible?
Yes.
Hi, thanks a lot for the opportunity. Uday, so as you hinted that there is some kind of froth in business banking or some kind of risks emerging in business banking. Do you think the similar risks are emerging in retail after 15 years of good credit cycle and in home finance after almost, in home finance after 15 years of credit cycle and in retail after say 10 years of...
I think the simple question we need to ask is when we are lending in the retail segment, it has to be one of the three. Pure cash flows of the borrower, pure security of the borrower, or a combination of cash flow and security. What I am just highlighting is just that in the one part which is so-called security, whether it's in pure security or cash flow per security, when we as financiers lend in that any segment where we think the security value is X, which is the basis for our comfort, I'm just making a point that there is an issue. An issue may differ from company to company, bank to bank, ability of technical underwriting, but there is no regulation of valuers in finance. Anybody in India can become a valuer. Is there, am I right, Venkatu? And therefore, what is the basis of banks and NBFCs or finance companies depending on a valuer's report? And there is no liability, nothing, no accountability. And we all merrily lend. And therefore, the underwriting standards of each of the financiers in the absence of industry standards. For example, you have a rating agency you have rating agency standards. You have auditors, which there are bases that they are supposed to be registered chartered accountants. Who is regulating the collateral valuers based on which banking industry is giving lakhs of crores of money?
Right. But you don't think that similar underpricing of risks is happening in any category of retail?
On consumer, I think we, post-2008, with the development of credit information bureaus, was a big transformative change in terms of how consumer behavior changed, which particularly helped the unsecured consumer. The challenge is, as more and more players come in, more and more people start lending to that same consumer, at some point of time, there is no back-testing models, and we will reach levels of over-leverage. But at this stage, I do not think we are there. Could we get there in 2 years? Possibly.
Okay. Thanks a lot.
Thank you very much. Ladies and gentlemen, due to time constraints, that was the last question. I now hand the conference over to Mr. Uday Kotak for closing comments.
Thank you very much, friends. Therefore, I believe that the broader theme of a reasonably stable Indian micro, other than pockets of challenges, is the story which plays out. Macro will have a disproportionate factoring in terms of how the risk and the opportunity in the financial sector develops over the next few quarters and years. There is, of course, the whole political situation which we need to watch out for. But within these broad contours, I do believe for a firm like Kotak, this is a time for a significant opportunity to be increasing our positioning and market share. And I thank you all for being on this call. Thank you very much.